Welcome back. In the past 2 days, we've had a slew of economic numbers released, starting with the Empire State Manufacturing Index with an actual reading of negative 32.9, falling short of estimates of a negative 7 in the previous number of 11.2. Retail sales also marked a disappointment at a negative 1.1%. The PPI, Producer Price Index, fell short also of estimates at a negative 0.5%, as well as the industrial production at a 78.8% level, falling short of the forecast of 79.6 and the previous number of 79.4. So in all four cases, Empire State Manufacturing, retail sales, PPI, and industrial production, we see declines falling short of estimates. Taking a look at the statistics, first off, we see here advanced retail sales at a 677,136, marking quite a significant decline. In fact, this is the lowest number we've seen going back to May of 2022. Industrial production at a level of 103.43. This represents a new low going back 10 months to March of 2022. This is the lowest low we've seen in nearly a year. We can also consider the PPI, Producer Price Index, 258.079, marking a decline. It's actually also a new 10-month low. This is the lowest number we've seen in the past 10 months, going back to March of last year. In addition to, of course, the New York Empire Manufacturing Index at 543,296, and that is the lowest number we've seen going back to May of last year. So we see either 5-month lows or in a couple cases actually 10-month lows for these numbers. And if you recall, this follows a weakening CPI, Consumer Price Index report, which also shows that inflation very much is waning. Now, taking a look at the statistics from a little bit of a different point of view, we can see over here the advanced retail sales marks a second straight decline. This is on a month-over-month basis and continues to weak over time. Same holds true for industrial production. This is a third number in negative territory. We can also consider the PPI at 0.01%, as well as the New York Empire Manufacturing, which is at a negative 1.78%. And that's the first negative number we've seen in about 4 or 5 months. Now, with that said, we can take a look at the trend of the numbers. In particular, take a look at the advanced retail sales on the right-hand side. Now, this particular chart has a green background because the last time we spoke about this number, it showed us a healthy uptrend. So we put a green background on it, but we can see now the advanced retail sales has initiated a pretty strong trend to the downside. The industrial production number now has a red background. It continues to make lower lows over time. Here we can see from a graphical point of view exactly how weak these numbers appear to be. We can consider the PPI, Producer Price Index, that shows a very steady decline to the downside over time, as well as a New York Empire Manufacturing Index, which is the lowest low we've seen in quite a long time. Now, as we see especially the inflationary numbers like the PPI today and the CPI earlier continue to show us weakness, we also see yields come down, the US dollar goes down as capital moves into bonds and out of what would be perceived to be equity investments or higher risk investments. So with that said, we see the blue area chart, that's the 10-year bond, and we see yields are now trending to the downside. The red line represents the mortgage rate. That's the average rate for 30-year fixed mortgage, for 30-year fixed mortgages. Now, the spread between the mortgage rate and the 10-year Treasury bonds rate, that's known as the mortgage spread. The 10-year Treasury bonds subtracted from the mortgage rates. So mortgage rates have a little bit of an extra yield, but this ratio, this relationship is not locked. During, I would say, more optimistic economic conditions, we tend to see a premium on the mortgage rates as investors are running after to purchase homes. But conversely, mortgage rates tend to decline if there's more of a negative or pessimistic mood within the housing market. The black line here represents that mortgage spread. Again, the black line represents the mortgage rates, the average 30-year mortgage minus the 10-year Treasury. So When this line goes down, it means the premium for mortgages, the extra that home buyers are willing to pay for a mortgage, is dissipating. The orange area chart is the S&P 500. And we can see over time, not a perfect correlation. We did see mortgage rate spread, the mortgage spread really spike as the S&P 500 went down. There may be a lagging effect in the sense that the stock market may have moved down in anticipation of these higher yields. Eventually, when the yields get so expensive, that chases away home buyers. But in any case, we see the S&P 500, it's been strong over the past couple days, but it certainly is not breaking out to any significant highs. We have not yet broken above the highs we accomplished late 2022. And meanwhile, the mortgage spreads continue to dissipate, now hitting levels, almost levels we haven't seen since September of last year. So if we expect, or we should say this, if we see that the economic numbers start to improve. Now, the inflationary numbers are a different story, but we look at the New York Empire manufacturing, industrial production, retail sales. We want to see those numbers go up. If those numbers do go up, well, maybe that'll bring optimism back to the housing market, and we'll see the mortgage rate, the mortgage spreads increase. But conversely, even though inflation is falling at the same time that industrial production, manufacturing, retail sales are also falling. So a negative on one number and a negative on inflation, now we perceive to be good, but that should occur for the right reason. A negative on inflation that also weighs on retail sales, industrial production, manufacturing, well, that would be perceived as a negative overall. Now, it may translate on the short term that the Federal Reserve will, be very, will not tend to raise interest rates. But the fact of the matter is, the overall economic condition of the economy, I think, is, really hangs in the balance. And if we continue to see these manufacturing numbers and the retail sales numbers decline, yes, the Federal Reserve will be less likely to raise interest rates, but that could also tell us something else about the economy, which would not be good news. We hope this has been helpful. We look forward to seeing you back soon.